All right, now let's take a look at depreciation. It's another type of adjusting entry, and it represents the expense that we are incurring when we use up a physical asset that we own, like a mixer. So Natalie, in the case of Cookies Creations, she owns a mixer and other equipment. As that equipment is used up, it's an expense that she has to recognize in her business. If she fails to recognize the expense of using up her equipment, she's not going to be tracking the full expenses that she's incurring. Imagine you pull a mixer out of the box, it's brand new, shiny, has a full life ahead of it in terms of maybe 5 years of use. Then 5 years pass and the mixer is slowly used up. At the end of 5 years, that mixer is going to end up in a junkyard or a landfill. You're going to throw it out or recycle it. So what we want to do is we want to show the gradual using up of the asset. Okay, we don't want to, at the end of 5 years, for instance, all of a sudden have to buy a new mixer and be surprised by the idea that our mixer wasn't worth anything at the end of 5 years, and that we have to incur a brand new investment in a new mixer. So what we're going to do is we're going to use this thing called depreciation expense. Now, depreciation expense is something that we're going to recognize. In this example, we're going to show it recognized as an equal slice of expense each period. So in this example, in the next couple slides, we'll look at a $40 per month depreciation expense. I will note there are multiple ways to compute depreciation expense. It is a topic that we'll get more in depth in a later chapter. But for now, just kind of know that depreciation is a type of expense and that we will have to record it, and it is an adjusting entry. So let's jump in and look at how we would record this. And I will give you an upfront sort of alert that we are going to be introduced to a new type of account called accumulated depreciation. This is what's called a contra asset account, meaning it's an account that sits on the asset side that is always credited, and it's paired up with equipment, it's paired up basically in this example with equipment, but whatever's being depreciated has an accumulated depreciation account. And we'll look at this in a moment in greater detail. When we record depreciation expense, so let's stick with this $40 of depreciation. We're going to show it as depreciation expense, meaning we debit it under the equity, just like we would debit any expense. And then we're going to credit it under the asset, and it's going to be accumulated depreciation. This is the contra asset account. Now, let's look at the journal entry. The journal entry is going to be typical to any other expense. We're going to debit the expense of depreciation expense. We're then going to credit accumulated depreciation / equipment. That's the name of this new account that we're looking at, accumulated depreciation - equipment. Now, how will this look on the balance sheet? Well, and also with the posting. What we're going to do is our equipment account is not going to change. Okay, that still is going to show $5,000. But we're going to have a new account called accumulated depreciation, where each month we're going to list each little slice of depreciation that we're going to book. So over time, the accumulated depreciation account will have repeated instances. So adjusting entries at the end of every month being posted to accumulated depreciation in the amount of $40. And you can see that example right here. Also, each month we're going to show depreciation expense in the amount of $40. Now, one final thing to note here is that when we look at our balance sheet presentation, this is how the equipment and the accumulated depreciation contra asset account marry up or work together. We're going to have the equipment account, which is an asset, and then we're going to have the contra asset account called accumulated depreciation. They're going to be paired up, and then the difference between the two is going to be the net book value of the equipment. So let's think about this equipment that cost $5,000 when it was first put into the business, and then after 1 month, it's $40 of depreciation is reflected, meaning the equipment now is $40 has been used up, so to speak. The equipment has been used up and it's no longer worth the full $5,000. Now it's worth only $4,960. So this is how we would represent that. We need this contra asset account called the accumulated depreciation to show the net book value. Okay, and that's kind of what's the new piece here with depreciation. So we'll learn more and we'll look at this more in Natalie's case with Cookies Creations. Thanks.